Hello everyone, welcome to Money Minutes. This is your host. I'm Zak Gardezy. I'm also the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner and a private wealth advisor. So this is the final episode of Money Minutes for 2024. So I'd like to start off by saying thank you to all of my clients, family members, friends, and partners in the industry who have supported Money Minutes all year with your feedback, subscribing to the channel, and just all the awesome comments that I've received throughout the year. I'm looking forward to providing you with great content in 2025. And so once again, thank you for all of the support. Now for this week's episode, I want to focus on a couple of interesting topics. One is centered around interest rates and how the Fed's comments and the fallout from those comments has affected the Treasury market, mortgage rates, and the overall outlook for 2025. I'll also focus on a couple of interesting market effects that tend to happen during this time of the year. One of those is called the Claus Rally, and the other is the January Barometer. And so we'll focus on these two topics today, and let's get right into it. So we know the Federal Reserve cut interest rates on December the 18th. They cut interest rates by 25 basis points. And also, the chairman of the Federal Reserve had some comments that were not well received by the market. It was actually one of the worst days for the S&P 500 all year. And the summary of economic projections was released, which shows where Fed members think inflation, economic growth, and where they think how many interest rate cuts are they going to do for 2025. All of their thoughts are sort of released on the summary of economic projections. And there's also some questions that the Fed chairman received around why some of their inflation and interest rate cut projections were changed from the September meeting. And so there was a lot to digest after the December 18th meeting, a lot of which I covered in last week's episode. But now we're seeing continued effects in the market as a result of this latest piece of data from the Federal Reserve. I'll start by talking about the CME Fed Watch tool. So again, this tool helps track where traders think interest rate movements are headed. And we previously noted that there was possibly 2 interest rate cuts that traders were pricing in, and potentially starting in the month of March. As I just looked at the CME Fed Watch tool, we're seeing 1 interest rate cut potentially starting in the month of May. So traders are starting to become less confident in the movement of interest rates, and this is going to have reverberations across the market. So for example, these expectations of higher interest rates are already finding its way into the 10-year Treasury yield, which has climbed up to some of the highest levels that we've seen all year. Now this is important because the 10-year Treasury yield serves as a bit of a benchmark telling us where interest rates are headed. For example, mortgage rates tend to track with the movement of the 10-year Treasury. And so as the 10-year Treasury has moved up since the Fed made their comments, we've seen naturally mortgage rates move up to some of the higher levels that we've seen throughout the year. We're not over 7 or 7.2 or somewhere in that range, which were the highest levels all year, but we're certainly a lot higher than the low points and some of the median points that we've seen throughout the year. So definitely the Fed's comments has already made its effects into the mortgage market, which then trickles in to the overall housing market, which has been quite weak. As I noted in last week's episode, it was one of the weaker points of the economy that the Fed noted. And so paying very close attention to what's happening with the Federal Reserve, with inflation, and the overall expectations around interest rate cuts. The next Fed meeting will conclude on January the 29th. Currently, there are really not a high chance of a rate cut in January on the 29th, actually. And so I would not expect a rate cut then. But, of course, we get fresh data, CPI, PCE, again, more inflation, labor market data. And maybe the Fed will have a different attitude after the presidential inauguration and some policies go into place. Again, a lot of this is fluid, variable information, but we're paying very close attention to it because it is having direct effects on the market and on client portfolios. So Yale Hirsch was a very famous stock market researcher. He was also the person who founded the Stock Traders Almanac, and he coined the phrases the Santa Claus Rally and the January Barometer. And so both are interesting market events that tend to happen during this time of the year. The Santa Claus Rally, which sort of officially kicked off on Christmas Eve this year, it's a market event that shows that the market has a tendency to have a positive return during the last 5 trading days of the year. there's not really a clear-cut reason as to why. Some point to the holiday spirit and people just being more optimistic and positive at this time of the year. Some point to institutional traders being out of the office, and so trading volumes are just naturally lower. Again, not a real reason as to why the Santa Claus rally tends to happen, but it just does. And the January barometer, that's also another interesting sort of market dynamic or theory, and it's fascinating. So it's been accurate 75% of the time, roughly, historically. And so what the January barometer tells us is that the returns in January tend to explain whether we're going to have a positive or negative year for the S&P 500. So for example, if you have a positive return in January, you can expect a positive return on the S&P. If you have a negative January, you can expect a negative return. Now, I looked back over the last few years to see how accurate this has been just in recent times. It's pretty interesting. So 2024, of course, unless something dramatic happens, hopefully not by the time this video is posted and the rest of the year plays out, it's been a positive year, a very positive year. And January was a positive month in 2024. 2023, same story, positive month, positive year for the S&P 500. January 2022 was a negative month. And of course, many of us remember 2022. It was a terrible year for the stock market and the bond market. But again, focusing on the stock market here, it was accurate. The January barometer was accurate in 24, 23, and 2022. However, it was wrong in 2020 and 2021. In 2020 and 21, Januaries were negative. And we remember, those were great years for the market, although it was during COVID times and the markets were extremely volatile, especially March of 2020 was a terrible month. Overall, the markets had strong double-digit returns both years. And so, again, not an exact science, neither the Santa Claus rally or the January barometer, but they're just two very interesting holiday sort of start of the year market events that we should all know about, and it's quite fun and interesting. And so this concludes this week's episode of Money Minutes. Thank you so much for tuning in. And again, I'm looking forward to bringing you great content in 2025. Thank you again for all your support.